Let's get to our market panel. Joining us now is Vital Knowledge founder Adam Crisafulli and Macquarie Group strategist Terry Wisman. Welcome, guys. Adam, if you're going to change anything in your portfolio, you're playing at home ahead of Nvidia, I guess this is your last chance, right? Like tonight, tomorrow, so you got to make your plan. You're going to get Nvidia and then Jackson Hole. So what kind of investor should consider changing something, do you think, depending, I guess, on how aggressively one has been positioned?
Yeah, I mean, obviously both are going to be critical catalysts, in terms of how the market reacts to both. I think for Nvidia, obviously expectations are enormously elevated. That doesn't mean necessarily that the results are going to look bad. I think, all signs suggest that Nvidia owns this market and demand is off the charts. I think there are certainly questions about whether or not there's a lot of demand getting pulled forward. And there certainly will be a lot of competition that starts to hit around Q4 and into next year. But for now, they own this market, and demand is extremely hot. I would just note that before we get Nvidia tomorrow night, you're going to get analog devices and semiconductors before the open. So that's going to give you a little bit of insight into kind of the broader world. Obviously, not really much to do with AI, but just a broader look at semiconductors. And then there's an important labor update, revision to the past year for the jobs market, that could factor into the tone of Powell on Friday. So I think that 10 a.m. labor update is going to be very interesting to watch. The expectation is you'll get a cut in the amount of jobs that were created over the last 12 months. And if that does happen, that could play into, again, the message that Powell conveys on Friday at Jackson Hole. Maybe
a little less pressure, sure. Terry, it sounds like you expect the Jackson Hole commentary out of Powell to put maybe a bit of a floor under yields, which I guess would make it potentially tougher for equities to run higher from here. Is that right?
Yeah, that's right. Because if you look at what the theme of that symposium or conference is, the theme is going to be talking about structural changes in the global economy. Now, when you're talking about structural changes in the economy, and you think about what those major themes are, those major narratives are, you've got deglobalization, you have changes in demographics, you have climate change, you have high debt in many of these emerging markets. All of those themes sound as if they should be inflationary. Some of them are, in fact, negative supply shocks. So if Powell were not to speak about the next few months and instead took a more medium-term or longer-term view about the inflation outlook, you would tend to think that he's going to sound a little bit more hawkish. And that would not necessarily put a floor under yields in the next 6 months or policy rates in the next 6 months, but it may put a floor under policy rates in 2024 and 2025.
Okay, so Terry, if you think that's going to happen as an investor, what should you do?
Well, you don't necessarily want to sell bonds. The reason is because the yields have already gone up quite a bit. And technical positioning in the bond is actually quite short right now. So I wouldn't be surprised if you got some negative activity data in the U.S. and maybe some more signs of disinflation over the next few weeks and months. All of a sudden, yields come down. But that's a short-term view. That should be somewhat separated and made distinct from Powell's more medium-term and long-term view that he's going to offer at Jackson Hole.
Okay, so Adam, speaking of rates, if we look back down at the company level and even at the consumer, something that caught my eye out of Macy's was the rise in delinquencies on the credit cards there. And I can only imagine, as they saw that spike pretty quickly, if rates stay high, people who stretch themselves buying stuff at Macy's and other places are going to see those bills harder to pay off and probably more difficult to take on more debt. And that's before we even start thinking about what's happening with student loans. What do you think that means?
No, 100%. I agree with what your other guest talked about with rates having, I think treasuries are very compelling right now on a risk-reward basis in terms of buying in the short term. I do think you're going to see more growth headwinds emerge, especially on the consumer. So the Macy's credit card commentary was very notable. It definitely contributed to the sell-off you saw on financial stocks today, including the monoline card companies. The consumer excess savings are just about exhausted. They'll be exhausted, depending on what estimate you look at by the end of this quarter, the end of this year. Student loans are going to be another headwind. And there is a slowdown in the labor market. We've been very, very resilient on the employment front, and that's still the case. But you're still seeing a slowdown in job creation. You're seeing a softening in total take-home compensation, which is a function of wages and the work week length, which is important to look at. So all those factors, I think, are going to certainly become consumer headwinds going forward. And Macy's was definitely a huge red flag. for the broader credit quality for these credit card portfolios.